What's going on, guys? Welcome back to the channel. In this video here, we're doing a stock analysis on AMD, loading this up in the stock research tool built by yours truly. Earnings are coming up for AMD, so I want to just go and skim through the numbers and see what's going on with this company and see where it lies. We're going to calculate the intrinsic value, and that'll be at near the end of the video. But we're going to look at the company metrics, which compares the 5-year averages to the trailing 12 months, and the financial evaluations category here of my software, which looks at the company statements to try to grasp where this company has been and where it is going. So with AMD, our price has been on a little bit of a decline from 2021. We've hit a high of 164, folks, and a low of 71 in the 52-week range, currently sitting at 102.31 at the time of recording this video. So what we want to see here, when we look at the company metrics, we want to see anything that kind of sticks out to us. So with our PE ratio, we are actually down over a 5-year average, which is healthy. We want to see that come down, but it's still astronomically high, sitting at 52.89. But our EPS is up, earnings per share is up over our 5-year average. ROE is down from 23% to 10%, but our profit margin is up. So a little bit of a mixed bag here, folks. We have a lower PE ratio, a decently increased EPS, a lower ROE, which is not that great, and our profit margins are up. So 50-50 on that. But going through our other numbers here, our average free cash flow is $800 million, but trailing 12 months, they are crushing it, $3.46 billion. They have a decent 5-year return on invested capital, ROIC, 22%, but our trailing 12 months is at 5.86. Not that great. But their Allman Z-score is high, sitting at 7.45. We want to see this number over 3, and we have that no problem, as well as our Piotrowski score is 5. Overall, AMD has been doing extremely well in the semiconductor space. They have, obviously, their production coming out of Taiwan in conjunction with TSM, and with the semiconductor, I guess, boom and demand that's happening overall worldwide in so many different facets and industries, they are supplying for this great demand. However, our main thing is this company overvalued, and is it worth picking up? So this video is going to come ahead of earnings, so we'll see what happens. Now, jumping into our financial evaluations category, which looks at the company's cash flow statements, balance sheets, and income statements, we are ranking this company an 8 out of 10. That's a pretty decent score. It's actually really strong. The only parts that we're losing marks, or points in rather, is our 5-year PE average, where we want to see this company's PE average at 22.5 or lower. Now, unless they can justify this 76, this is a 0 for me. But granted, we are seeing a decrease now, sitting at 52.89, so something to keep in the back of our heads, as well as we are being diluted in shares, which is not a good thing. At 36% over the last 5 years, guys, that is horrible. That is horrible. If you're holding on to this company, guess what? You own less of this business if you've been holding this company for 5 years ago. So trace back to 2017. Whenever you bought this business, you essentially own 36% less of what you currently have. Does that make sense? Because we want to see companies buying back shares, reducing the share count. That way you don't have to share the profits with that many people, right? 36% increase, not too hot. However, out of those 2 categories, the remaining 8 categories are green in a lot of important places. Current ratio is over 1.5. That means they have enough assets on hand to cover their liabilities. So in case they run into a sticky situation, let's say an upcoming recession, higher interest rates, and it's harder to borrow money, they can sell off things, or they're not going to be in that much trouble. ROE on average is sitting at 23.62. It being over 15% is great, and as we expressed earlier, we have a higher EPS, so that EPS has been growing. And what I love to see here, folks, 4.66% on their debt to equity ratio. We want to see this number beneath 50%, folks. That means they are funneling money into the company and growing this business through equity and not through debt. And as it becomes harder and harder and more expensive to borrow money, we want to see companies keep those debt levels low, right? And along with that, their net income, crushing it. Their 5-year free cash flow, absolutely crushing it. The 5-year return on invested capital average, higher than 10%, which is great. And the revenue growth has been going up. So AMD is doing a lot of things right. The only things I can dock them for is this 5-year PE average, which makes me want to believe that this company is overvalued based off of their earnings and the price that it's currently at. But that's speculation. We will find this out once we jump into a price analysis, as well as our share dilution. I don't want to see them issuing out any more shares. But here's the thing, folks. Wall Street loves AMD. And AMD knows that. So why would they take on debt, as we expressed here? That's why the debt is low. When they could just issue out more shares. People are going to buy the stock? Yeah, no problem. Let our investors fund operations. Makes sense to me. So it makes sense to them as well. Jumping in, folks, we will do a price analysis. And what we're going to look at here, folks, is a 10-year evaluation. I'm going to fill out these boxes using these historical numbers to try to find a fair price to pay for this business. So stay tuned while I fill out these boxes. Okay, folks, so before we jump into the price analysis, if you're liking the video so far, hit that like button, hit the subscribe button. If you want to get your hands on the software that I've shown in front of me, stay tuned. It's coming out extremely soon. I'm working diligently to get this out to you. I'm a one-man show here, so it's a lot of work. Anyways, here's what I did. If you're new to the channel, I like to stay as conservative as possible to try to give myself the most ample margin of safety, because that's the name of the game, folks. Give ourselves the most margin of safety, so in case we are wrong, we're not wrong so much. As well as I want to put numbers in that if they can beat my numbers going forward, that's better. It's better for our back pocket. So with revenue growth, I stuck to our 10-year average numbers. So I did 15, 15.5, and 16. Granted, in 5 years, it was 32%. As well as our profit margin, I did 10, 11, and 12 based off our 5-year and 1-year numbers. And also that our profit margin currently is 14.5. So I stuck within that realm. Same thing with our free cash flow. And price to free cash flow, I kept it underneath 20. As well as with our PE ratio, I'm looking at it from a perspective as if this company was trading at below a 22.5 PE ratio. Plug that all in with a desired return of 13%. We're going to see what AMD comes out to be. Current price, 102. But overall, I love AMD. I like this company. I don't own any of their products, but I know they are very strong. Usually it gets paired up with Intel, and there's always that back and forth of which company is better. I think they're both great, frankly. It's just whether or not it's undervalued or not. And cycling back to our calculations here, it is extremely overvalued. Current price, 102.31, has to come down to 54.20 for it to be in a fair value price. Nothing is hitting. Now, you may say, Leo, your revenue growth numbers are extremely low, extremely conservative. You may be right. But for me, I want to be as conservative as possible. That way, if they can beat these numbers and I see green across the board, I know I'm in a very, very safe position if I want to invest in this company and they beat those numbers, because I know that I'll leave that room for error. So with that being said, we have 41 on the low end, 54 on the moderate side, and 66 on the aggressive side. So great company, just currently it's a little bit overvalued. I could up this revenue growth number and we can see that number climb slightly. However, it's not in that price range. I love the business. I like what they do. I like the products, but it is just not at where it has to be. As I expressed earlier, the prices doesn't make sense to me, as well as their PE ratio being high. But the main thing is the share dilution. If I'm buying into this company, I know I have to keep sharing my profits that the company's bringing to me with other people. It's not that exciting. Where on the flip side, you have a company like Intel, where they are buying back shares. They are shrinking the pot. That means fewer people are digging into it, which is great. So AMD, love to own you one day, but this has to change, and this has to change. Who knows? If they crush earnings when this video comes out, and you'll probably see this number increase. However, if they don't and it starts going down and hits this 50 range, even south of 60, it might be worth picking up. Anyways, folks, that's the video. If you liked it, hit that like button, hit the subscribe button. You want to see a company evaluated, drop it down in the comment section below, and share this video with a friend if they're looking to analyze AMD and maybe look at this process as well, if this excites you. A lot of things are coming up, folks. This software is going to be available to you, my viewers and subscribers. The community page is on the way as well. I'll see you in the next one. Thank you so much for watching.